Getting started on stock market as a beginner. Getting into stocks is not a difficult process. You simply need to choose the broker that you want to use and pick the right stocks and get started. You can easily transfer money, and as long as you make some good decisions and don't jump ship all of the time. Remember those broker fees for trades as well. You will see success and make some great money. You can follow the following steps as a beginner. Open a brokerage account. The first thing that you will need to do in order to purchase stocks is to open up your account. You will need to find a discount broker and then sign up online to have stocks. Take a look at the different fees that the broker is going to charge. Some will have a lot higher fees compared to others, and you could be losing money if you don't do your research. On the other hand, these expensive brokers may have value-added services you won't find on lower-tier brokerage firms. Fund your account. Now that the account is set up, you will need to put some money into the account. This is pretty easy to do, as you just choose the right amount you want to use and either send in a check or transfer right from your bank account. The check will take a bit longer, but most brokers will be fine in using it. Select your stocks. Once you have your money in the account, it is time to figure out which stocks you would like to procure. If you are doing this with a financial advisor, they will be able to look at your goals and help you find the right stocks to make money with. They can pick out a few options, watch the trends for you, and help you make some important decisions to get the best profit. If you are doing it on your own, you will need to be proactive and watch the different stocks to make sure you are picking the right ones to make a profit. Diversify. If you are a beginner, you should diversify your portfolio a bit. It is never a good idea to put all of your money in just one stock. Buy different stocks from different industries. Diversifying your portfolio limits your risk. Sure, you could make a lot of money if the stock does well, but if it does poorly, you could end up losing it all in one swoop. So pick at least 2 or 3 stocks to divide your money in. This way, if one stock does poorly, you still have the others to hold you up in making you money. Be patient and optimistic. The stock market is always fluctuating. You usually don't have a continuous increase or decrease without some ups and downs. This is why, even as a beginner, you need to stick with the investment. This can be hard right in the beginning. You are excited to make a lot of money and may feel like you aren't earning fast enough. Some people aren't willing to stick for 10 years or more with one stock in the hopes of earning some good money. But if you want to really make good money with this investment, you need to get into the stock market now and stay with it for the long term. This is when the best returns come into play. Now that you know what it takes to invest in stocks, we need to go into the trading process. I have classified stocks trading into 5 types based on duration. Day trading. Day trading is a type of investing where you will buy and then sell your stocks all on the same day. The trading will need to close before the market has closed down for the day. If you are a trader who goes in on this day trading, you are called an active trader. This is a good option if you like the ability to make money quickly and you're able to take fast action while making decisions right away. This is a tough kind of trading, and it is not recommended for those who are just getting into the stock market. Most stocks are going to see growth over time. But if you are following the stock for just a day, you may see a dramatic decrease during this time. As a day trader, you need to have a good understanding of how the market works, and be able to recognize trends enough to stay on top of it all. There are a few different methods that you can use when going with day trading. These methods include arbitrage. This can be helpful in capturing slight changes in the price. When there are differences in prices of a stock which is located on 2 different places, the trader would pick the one that is lower priced and then sell it on the higher priced market. For this one, you will look at 2 or more places for the stock. If they are all the same price, it doesn't make sense to purchase it. But if you can find it for a lower price, you would make the purchase and sell it on the other site right away for a higher price to make a profit. Before going on, if you feel that I have given you some value, please help me by smashing the like button, subscribe to my channel and turn on the notification bell. Market making. The stock exchanges are going to appoint the market makers, and will be the ones who provide ask and bid rates to the brokers when buying and selling stocks on the big exchange sites. Momentum day trading. This is a type of stock trading where a certain trade is made while the stock is trending in movement, and then the trade will close down at the end of the market day. Pattern trading. As the price of the stock goes up and down, you will start to notice a pattern over time and can even see them on the charts. You will be able to use pattern trading to determine if your day stock is going up or down so you can act accordingly. Scalping. This method involves getting small profits quickly from hundreds of trades during the day. You will use the ask and bid differences given to you, and make a ton of trades all day long. You will not make a ton of money off each stock, But overall, with so many trades, you are going to see a profit. Price action trading. With this method, you will only consider the price actions. You will need to decide on a time period from 1 to 60 minutes, and then you will trade it during that day. You will simply look at the open, high, low, and then close during that time period to make money. Rebate trading. This is a day trading method where you will be paid by your service provided for buying and selling stocks. News playing. This is a method where you will follow the news releases that show up during the day. You will decide to buy and sell based on these news releases, and it is going to be closed within one day as well. Short-term trading. This is similar to day trading, but you are going to have more than a day to get it done. It is usually between 2 days and a few weeks for trading. For this type, you will purchase a stock and then hold on to it for a day up to 2 weeks. After this time, you will sell it again, hopefully for a nice profit. This kind of trade is entered when you create a sell position, which will then be covered later on. Pattern trading and swing trading are good examples of how this works. Medium trading. This is where we get into the longer-term trading options for the stock market. This is usually going to last anywhere from a few weeks to a few months. The trend here is followed with tailoring any stop loss. Swing trading and Elliott wave trading are good to use when you want to stick with medium trading. This one is a good option if you like to follow the trends a bit more but don't want to work with the stocks for too long. Long-term trading. This kind of trading can last anywhere from a few months to many years. If you have a retirement account, you are probably playing with long-term trading because the stocks are going to basically stay put for a long time to come. You will see a lot less risk with this option because you have time to go through the different progressions of the stock and will generally earn a good profit. Caveat. All stocks go through periods of ups and downs. That is just how business works. If you are sticking with some of the shorter-term trading options listed above, you may be hit with some of the downturns of a particular stock without much time to come back when the stock prices go back up. With long-term investing, you may lose some money temporarily. But you can also see big gains in your money. When you stick with a stock for the long term, you are generally going to come out way ahead than you started. Talk to your financial advisor about going with a longer-term option if this seems like it would fit your overall goals. Making the right investment. To make a reliable profit from investing, you must understand two things well. What a stock is worth and what other people are willing to pay for it. Only then can you decide whether a specific opportunity is worth pursuing. Is now a good time to invest? If you found a good opportunity, the answer is always yes. For you to make money, any profitable investment has to increase in value somehow. If you buy a stock for $1 and sell it for $2, you've made money. So when to buy? Number 1. When a company's stock is undervalued. When you know the stock price of a company is lower than its book value, there is huge potential for growth in the future. This is like the opposite of a bubble, whereby a company's stock is trading higher than its real value. If you notice that a company's stock is undervalued, buy and watch patiently as market forces drive the price up in the future. You can know this from careful study of the company and analysis of its financial statement. If you are doing short-term investment, you may not be able to do this. Number 2. When a company is growing. If you have seen remarkable recent growth in a company's size, profit and stability, you need to buy fast. Remember, many other investors are studying the company just as you are doing. If they start buying before you, the price will start increasing. That is why you need to start investing early, but not too early. To minimize risk, you can have a predetermined threshold. Number 3. When stock price rises to your buy price. Since you cannot always predict accurately if a stock's price will continue to rise indefinitely or fall soon, you need to set up a range of value at which you buy a stock. For instance, if the stock price shows a rise of 5% within a week, and you can relate the increase to an increase in the company's growth, you can buy it in the second week after it rises from $21 to $22. Number 4. When a company is strong. Very big and strong companies are known as blue chips. The reason why the prices of blue chip stocks keep rising is because people keep buying them, and people keep buying them because they trust that they are stable. These companies have weathered the storms in the past and have come out stronger. Therefore, investors believe they will show resilience. If you are investing in the long term and interested in security, buy into a strong company and watch your investment grow steadily into the future. And now, when to sell. Number 1. When you realize you have bought in error. If you suddenly discover that you made a mistake while purchasing a stock, you need to sell it quickly. If you realize that while buying the stock you made an error in judgment or you have bought it for the wrong reasons, you need to sell it fast. It is a bad stock. The key to successful investing is to rely on data, strategy and analysis. And not on your emotional swings. If the analysis you carried out before buying is flawed, you will only make more mistakes if you hold on to it because you do not have control over it. The stock price may go up after you sell, but you won't be able to predict correctly what will happen to it in the future. It is true that everyone makes mistakes, but learning from a mistake that costs you a 10% loss on your investment could be one of the best investment decisions you could make. Number 2. When there is a significant rise. It is true that nobody can totally predict the market. Therefore, you may never know when a stock has reached its highest or lowest value. When a stock you bought for less is appreciating fast and it gets to the point you are comfortable with selling it. A cheap stock can become an expensive stock in a very short period of time for a host of reasons. Some of which are likely due to speculation by others. Take your gains and move on. To make it easier, always plan from the outset the limit of appreciation, which means the highest value the stock will get to before you sell. For instance, you can say that for every 10% increase in the value of a certain stock, you will sell 50% of your stocks. Number 3. When what initially drew you to the company has changed dramatically. This usually applies to long-term investments. We usually put our money in certain companies because they have certain qualities that guarantee security, growth and profit. These qualities may include stability, strong financial records and large market cap. When these things begin to change, it is time to review your investments. Sometimes the change is not significant enough to make you sell, but sometimes it is. For instance, if you bought into ExxonMobil due to its long-term stability, strength, size and market cap and the company is suddenly acquired, you will be the one to review your investment. If the new owner starts laying off workers and there is a lot of negative publicity, or the company starts losing money, it is time to sell. Note that other investors in the company are studying the same things as you, and if they begin to sell before you, you will start noticing a drop in the stock prices. Sell immediately, before you start incurring a loss. Follow your guts, but also be cautious. If you think the company can still bounce back, you may not want to sell all your shares. You can retain 30 to 40% for future trading. Another reason to sell is bankruptcy. If this happens, sell all your stocks immediately, without looking back. Number 4. When there is a noticeable dip in stock price. There is no reason to keep a losing stock. When you notice that your stock is losing value rapidly, sell it before it falls below the price you bought it. If you bought it at a higher price and you have already made a loss, then sell it immediately before your loss hits 10% so that your loss doesn't multiply. However, if other factors point to the ability of the company's stocks to rebound or the market is in a bullish trend, you may retain a few stocks. Let's say in the 30% range. Ultimately, the decision must be based on your risk tolerance. You should decide before you purchase the stocks how much you would like to see the stock grow and how much you are willing to lose on the investment. These are the tips to help you make money on stock market as a beginner. Hope this video helps you out. Please leave a like on this video and subscribe to my channel. Thank you.